if you're bullish into an imbalance or run a very, very short-term low. If it takes a 1 minute swing low out or a 5 minute swing low out and you're bullish and you're thinking for that 15 minute or 60 minute chart, folks, I'm teaching the model in case you're not paying attention. Once there's a 5 minute or 1 minute stop run against the direction you think the draw is, either the 15 or 60 minute liquidity, then you drop down to a 30-second chart. And the very first fair value gap, you enter on it. Your stop loss is 12 handles, and you aim for best case 15. He wants to grow beyond this, but he doesn't have the comfort level because he hurt himself doing things he was recklessly pushing ahead, trading with more contracts than he should have, blowing combines. Now, all of a sudden, the running joke is that it's me trading it. So either I'm 100% strike rate and I can trade and I'm doing his account, or he's following a model and he's doing everything right and it works and it's proof. So you all that don't like me are stuck in a conundrum now, aren't you? Because either way, I'm winning, fuckers. You like that? You like that? The house always has the edge, motherfucker. You're going to be looking for an hourly or basically a 60-minute swing high or a swing low that is likely to move to. It's in close proximity to it. It's been going up for the last couple hours or so. And it's just getting real close to an obvious 60-minute high. If it's not doing that, go down to a 15-minute time frame. Look for a swing high that it might be gravitating to. If it's gravitating towards that 15-minute high, and real important, here's the filter, folks. Okay, this is the fucking part that you're not gonna do. And when you fucking lose, you're gonna swear up and down that it fucking failed. On a 1 or 5 minute chart, if you're bullish, it must show a swing low taken and then reject and go higher. Whatever time frame, whether it be the 1 minute or 5 minute, whatever time frame that swing low is breached, it goes below it. It only needs to go by one tick. Doesn't need to close below it either. It just needs to go below it. That time frame that has the swing low, it must have a candle close up after it takes that low. Once it does that, you immediately drop down to a 30-second chart. But I can't have a 30-second chart. Then you can't fucking trade this model. Just apply it to a higher time frame. Instead of a 30-second, use the 1 minute and use the 15-minute and 1 hour chart. Everything's scalable. But I'm giving you something that you can test a lot. There's lots of examples doing this throughout the week, from the beginning of trading on Sunday to Friday's close. There's many instances of you going in and going to be able to back test this and have no bias. And you're going to have losing trades. It's okay. But you have to have whatever that time frame is, the 1 minute or the 5 minute, there has to be a stop run. One of the first primary principles I taught when I stepped out on baby pips is the real move will not happen. The dynamic price runs where there's magnitude and delivery and speed, that will happen after a pool of liquidity is engaged. That means if the market's bullish, if you think it's going to go higher, I think it's going to draw up to some level, whether it be a high, a relative equal high, inefficiency above market price, whatever that is up there, that you're framing as a reason for it to want to go up, it's far more likely to get up there with conviction and speed if there has been a short-term run on liquidity that's below the marketplace in the form of stops or sell-side liquidity. Because the market's going to go down to allow traders to buy those stops. What traders? Smart money. The algorithm is cowtailing to them. It's called handshaking. The market reprices to levels to allow handshaking to occur. That's the real term. That's exactly what's going on. And when those orders are being provided to the participants that are on the sideline, you're not seeing their fucking orders on the DOM, the depth of market. It's not DOM, by the way. DOM. When that is showing those numbers and stuff, their orders are not sitting there. Smart money's orders are not sitting there. They're not. They're not fucking sitting there, folks. That's why I'm laughing at you when you're fucking using it and you're asking me, show me your order book, show me your level 2 data. That's fucking bullshit. That's all bullshit. It's spoofing. Their orders are immediately piped in. Immediately. They're not sitting around waiting for you can read them. If they have their orders the size of their fucking orders and the volume of their fucking orders, if they were sitting out there where you could see them, you could really read sentiment then. They're never going to fucking let you do that. Why the fuck is it so hard for you not to see this? Because people on CNBC and people that are allowed to talk on CNBC that have no fucking real clout on Twitter. I've been on CNBC, so therefore my opinion matters. The fuck out of here. When it drops down to take the sell side when you're bullish, whatever that time frame is that has the swing low that it pierces and goes below, as soon as it does that, you have to wait for one candle to be up close. Once it does that, then and only then do you drop down to the 30-second chart and you wait for a fair value gap to form and then you buy. The best one is the first, but you can take continuous buys on a 30-second every time it creates a fair value gap or trades to a down close candle. You treat it like a bullish order block. And you can turn that single one contract model over time. If you submit to 3 months of doing it, you build discipline and you aim for that liquidity. But here's the thing. You might be just like my son and you're scared. You can't hold a trade. Okay. Best case scenario, put a limit order at 15. 15 handles, there it is. So you're risking 12 to make 15. That's not bad. It's a little bit better than 1. But most of the time, my son has 10, 11, maybe 11 and a half, sometimes 12 handles. And he moves his limit order around if he ever uses it. Sometimes he's honest with me. He says, Dad, I don't have a limit order because I'm afraid if I put it at 10 and it goes to 15, I'll be upset about that. So he's still not disciplined in that regard yet. He's growing, but this model allows him that growth. It protects him from losing a lot because he can only trade with one contract. He can only take one trade per day. He can only do one thing. And it keeps him in a tight little bubble where he can only, like a petri dish, okay? I've taken him and I've put him inside of a petri dish and said, okay, this is all you can fucking do. You can bloom and grow all you want, but you're never getting out of that fucking petri dish until I tell you new parameters. And so far, his growth has been perfect. It's showing him incremental gains. It's realistic gains. I think, honestly, if everybody out there, even people that hate me, those results are consistent, aren't they not? They are. They're not perfect. He's got an 80% strike rate in terms of his trades. At 18 years old, that's fucking phenomenal. That's fucking phenomenal. I don't give a fuck where you came from. That's good shit. But see, you are equating it to some of the things that I've done or you see other people do, and they may not even be true. Don't look at the amount of money as the reason to say something is good or bad. Because what if you were making $250 a day? That's going to mean something to you, isn't it? It's going to mean a whole hell of a lot to you. Whatever you're aiming for, as far as the draw on liquidity, over time, you'll learn to hold it a little bit more. See, he has to submit to this for a few more weeks before he's allowed to go for 20 handles. Because he's not going to have, right now, he doesn't have it yet. He doesn't have the wherewithal to be able to hold the trade for 20 handles because he's nervous. He's afraid. He's expecting one of those weird, crazy, big down close candles or wicks that come against him real quick. He's expecting it. That's what he's having in his mind. He thinks they're going to jump out like a boogeyman. And you're laughing and smiling, thinking, it's exactly how I feel every time I'm in a trade. And you know how you beat that? You know how you beat that boogeyman? You just constantly engage and you desensitize yourself to it. And you see how many times does it really manifest itself? It might happen once a month. If you're following rules, if you're bullish and a stop hunt just takes place on sell stops, chances are they just engaged that liquidity and smart money just went in and added more. Then the algorithm reprices higher. Not because they bought it, not because of the buying pressure. The handshaking element that the algorithm does, it delivers to a pool of liquidity. It doesn't know how many orders are there. It can't know how many orders are there because it's always changing. Orders are coming in and being pulled, spoofed, putting in, put them out. Like that's not a factor when it was coded. It's just where will they be? At what time are we interested in going there? That's how the algorithm is coded. So when that handshaking event takes place and allows the liquidity to be engaged, whether it be purging or engineering new liquidity, that element brings with it a context of what price action should do next. So if you know the likelihood of those stops above relative equal highs, below relative equal lows, or above a single high or below a single low, you're framing where the liquidity is that the algorithm will refer to. And then you sit there and you wait. Which one is it gravitating to? Whatever one it gravitates to or starts moving towards closest, you can use this model. And you can take 10 handles.